types of mutual funds. There's the bond fund, there's the money market fund, there's the balanced fund, there's the equity fund, and there's the real estate investment trust, better known as the REIT. So that those are the 5 different mutual funds that there are in Kenya. So I want us just to dwell deeply into each of them so that we can have an understanding. What we say is that a fund gets its name from where the fund manager will invest the funds. So starting from an equity fund is where the fund manager invests in the stock markets. Pretty much equity stocks and shares mean almost the same thing. So an equity fund invests in shares. Now in Kenya, the equity fund has not performed well with any of the fund manager. And the main reason why equity funds may not perform better than other kinds of funds is pretty much because when we pool funds and you have a lot of money, let's say you have R1 billion to invest in the stock market, there's no advantage you have when it comes to purchasing stocks. What I mean is that Safaricom share, whether you have 100 shillings, 1,000 shillings, a million or a billion, it will cost the same amount of money because the market is demand and supply forces. In fact, what happens is that when fund managers come with a lot of money and say they want to buy a particular stock, because already the demand goes up, because remember they are coming in with a lot of money, you will see the price going up. And so the fund manager might end up buying the stock more expensive than an individual who's just buying 100 or 1,000 stocks of the same counter. And so because of this, we find that the equity fund has not been performing well. That coupled with the fact that the Nairobi Securities Exchange, in the last 10 years or so, it has not been performing bullish in a strong way. We've not seen any IPO in the last 7 years. And so it's not been performing at its optimal. And for that reason, most equity funds have not been performing well. And towards the end of this video, I'll be sharing about the performance based on our research for different fund managers. The second fund is the money market fund. The money market fund, or also known as the MMF, is the most popular fund in Kenya. In fact, over 70% of the funds in mutual funds are actually the money market fund. And the main reason is that the money market fund has been performing well over the years, performing better than all the other funds. And so for that reason, it's popular, it gives a good and decent return. So money markets is simply what you call the wholesale of money. The people who want money in the billions will go to, that space is what is called the money markets. So for example, when you're borrowing money in a lot of money, or when you have a lot of money, like the fund managers, the pension funds, they usually give and buy and sell money in these money markets. And so money markets are short term, less than a year, but they are funds that you and I, the common investor, might not be able to play because they require a lot of money. But what we discovered is that because you're pulling a lot of money, the more money you have, the more you're able to negotiate for higher funds. For example, if you have 100 million, you can go to a tier 2 bank and be able to get 12-13% return on your investment. If you have 1,500,000 shillings, you might not be able to negotiate the same rate. And so for that reason, money markets in Kenya have been performing much better than their counterparts. And so that mutual fund that there is what you call the real estate investment trust. Now, the real estate investment trust, also called as a REIT, is where a fund manager collects money and invests in a portfolio of real estate projects. Maybe they buy a couple of buildings in town, and then the rent that is received is distributed to the investors or to the unit trust holders. And so there are two kinds of real estate investment trusts or REITs. There's what is called D rate and I rate. D rate simply means a development rate. I rate is an income rate. So the D rate or the development rate is where a fund manager collects money, buys a piece of land, develops a property, sells, and the unit trust holders are able to get the profit from the whole development process. Because the houses are sold at a markup, and the unit trust holders are able to get a profit from every project. So that's a day rate. But in the I rate is where a fund manager collects funds and buys a portfolio of buildings. And so the people who've invested in the funds are simply making their income from the rent collected from those properties. That's an income rate or an I rate. Yeah, so that's that kind of fund that there is in the market. The other mutual fund available is what is called a bond fund. It could also go with other names like high yield fund or the income fund. They pretty much mean the same thing. But in that particular mutual fund, the fund manager collects money and puts it in bonds. Bonds again are fixed income investment products that are long term, more than a year. Like the treasury bond, anything more than a year, the corporate bond, the treasury bond. So the fund manager invests in these particular products. And so it's quite competitive. It's as competitive as the money market fund. But again, it has not been performing as well, but it's a good place that you can diversify your money. The advantage, number one, is the fact that with the bond fund and with the money market fund, because they are fixed income products, your capital or your investment can never go down. What I mean is that you can't put in 50K and then it goes down to 49K. But with equity fund, that can happen. With rate fund, again, if we get into a development and for a reason it gets into a loss, there's a possibility of losing your money. But in money market fund and bond fund, your capital is preserved. Finally, the last mutual fund that there is in our markets is what is called the balanced fund. And balanced fund is where the fund manager has the discretion. They can choose to get into some equity, they can do some bonds, they can be able to get into any of these markets. And pretty much the fund manager is able to decide what product is performing well. Or they're able to diversify the fund so that it has some aspect of fixed income and it has some aspect of risk of variable income, for example, from equities. So they can put some of the money in stocks, some is in money markets like treasury bonds and treasury bills, some bond fund. So they can play in any of these markets with an aim of getting the best return on the investment put. And so these are the 5 different types of funds. And so for us, we advise, since the money market fund has been performing better than the rest, for now, at least in this season, it's wisest to put your money there because your guaranteed returns that are decent, around 10%, your capital can never go down, and it has been performing well over the years.